slightly different tack now. Now, we've all heard about the need to reduce emissions and lots of companies talking about how they're going carbon neutral and aiming for net zero and so on. A lot of funds do that. They'll tell you, well, we don't invest in coal or oil and gas, and some apparently have been saying that but not doing it, but that's a separate issue. Our next panel is also going to talk about what opportunities there might be in the move to net zero. Is it something we can actually invest in, other opportunities to make money in the move towards net zero? The moderator for this panel is Kieran Rooney. Kieran is a senior consultant with Evergreen. Please welcome Kieran and the panel. Thank you.
Thanks, David. So this session we'll be talking about net zero as an asset class. And given it is so topical, I do want to throw to the floor as much as we can for questions. But first, I believe we're starting up with presentations. So we've got John Woods, Head of Asset Allocation at Australian Ethical. And then we've got James Kingston from iShares with the rather long title of Head of Product Practice and Portfolio Solutions for Wealth Portfolio.
Clearly I smell bad because there's a gap in between us.
And so I think, James, is it you that is presenting first? Or?
I don't know, am I? We'll find out. Oh, it's you.
No, it's John.
Like me. Yeah, look, I'll stand up. I don't like sitting down. So look, net zero as the next asset class, like it's a really, really big question. And I pose all big questions to my 6-year-old. And I asked him, what do you think about net zero? And he said, Dad, don't worry about it. In 2050, we'll be living on Mars. I'm a little bit more bullish on our outcome to achieve this goal. And one of the reasons I think that is the investment hurdle is surmountable. And one of the reasons we might think that we can put net zero in an asset class is really when we look at it in terms of size. Investopedia's definition of an asset class, it's really helpful, but there's lots of things that fit this definition of a grouping investments that exhibit similar characteristics. What really makes an asset class is it big enough? And when we look at groups like the IEA, they talk in numbers of trillions of dollars to address this challenge. So on that basis, it would be an asset class bigger than government bonds, similar to global equities as it stands today. So it's a really big challenge ahead of us. But to call it an asset class, I think, misses some of the detail. And we've been in a little bit of a position like this before. So the chart I've got up there at the moment on the far left-hand side looks at the composition of equity markets back in 1900s, and it compares it to the composition of equity markets today. There's a big shift. The big shift was transport. Transport was a catalytic industry in the 1900s, and that's the type of mental model that I'm thinking about for how we approach this net zero transition. Transport overcome the tyranny of distance at that period, and it made up an exceptional part of global equities indices. And then after it had served its purpose and connected the world, its benefits flowed through to other sectors, and it's a far less significant sector today. 50 trillion sounds like a lot of money, but if you're investing $1 trillion a year and it's compounding, we know what those charts look like. So I think that challenge of reaching net zero by 2050 is surmountable. The impacts, however, are much broader than an asset class. In fact, it touches on all parts of your portfolio, and this is where I think we need to think a little bit more broadly. This is our process for thinking about how we get to net zero in 2050 is an asset allocation team. We run a scenario approach, and the challenge for investors here, there's 2 climate scenarios on that chart, and they're at both ends of the spectrum, a negative climate scenario and a positive climate scenario. So what are we talking about? We fail to address the challenge. We face the consequences of failing to address the challenge: resources scarcity, increasing pandemics, supply chain disruptions, the type of narrative that we've all become familiar with over the last few years. On the positive side, look, it's a big ask, but it's possible that one of the benefits of addressing climate change is it brings with it actually a lower cost of energy, not a higher cost of energy. And if I look back at what's actually driven the success in markets over the last, four decades, a large part of that has been doing more with less. We've managed to increase human productivity, and with that, it's benefited financial markets. So the positive climate change scenario is around that. And really, all we're asking for there is if we can address climate change successfully, we get returns a little bit more similar to what we've become used to over the last decade. They're frequent in recent history, but they're far less frequent in the last 150 years, and they're almost non-existent in the last 1,500 years. So it's actually a big ask just to deliver what we've done over the last decade. And that's why I think addressing such a big challenge like net zero is part of the way we get there. There's a really important distinction, though, between the 10 years we've just been through and the 10 years that we're going into. So I would argue that the framework we've been existing under for the last decade is certain sectors of the market have benefited because of the economy. What we're transitioning into is we're asking for more, a little bit more like the transport stocks at the end of the 1900s, at the end of the 1800s, sorry. We're asking them to be the catalyst to drive the economy. So if you look at what's just happened, the environment we've just been through, the emerging market exported deflation, we know the story. It kept inflation under check. It benefited stocks like Amazon, like the technology sector, and it brought benefits to consumers. But that was a product of the economic environment we were in. The success of those companies was dependent on the environment they were offered. The environment itself didn't depend on the success of Amazon. Sure, there's some great things. I love being able to not go to shops anymore. Never liked them in the first place, and to never have to go to one again is fantastic. But the real benefits there came from the opening up of the emerging world. Now what we're asking for investors to invest in catalytic technologies, invest in renewable technologies, to actually drive the economic environment we need to deliver the returns we've just had. And that's a very big switch. We have to allocate capital efficiently so that it's productive and addresses the problems we have. Has been done before, hasn't been done in the last 100 or so years, but it has been done before. So net zero, not so much an asset class, but an investment thematic that's pervasive across all of your portfolio. Some of these things are really simple. You're probably already invested in it today. A net zero investment might be investing in the trend to switch from private transport to public transport. A lot of global equity portfolios would already have European and Japanese railways in them. So we're not breaking it out. There's more direct investments into the sector, addressing energy. Energy is a really big theme. So, names in the renewable sector, New Zealand Renewables, Tesla, Vestas producing those type of technologies, but all the way right back at the start as well in venture capital, trying to work out ways to be more efficient, to build better batteries so we can address this problem. So I think what you'll find if you start digging through your portfolio, there's a way to take exposure to this no matter what you're invested in. And given what we saw on the previous slide, that what we're facing here is one of the most difficult investment problems. We're facing two extreme outcomes, the bottom 10% of the distribution and the top 10% of the distribution. Addressing that challenge is hard. So you're looking for investments that have convexity, optionality. So for both ends. So one of the reasons that venture capital is a really interesting way to play this particular thematic is it offers optionality to this thematic. So if we move into that top 10% of the distribution, the probability of that outcome increases, those assets benefit more. The bit that makes up more of the bulk of your portfolio is more around the larger cap names that you've probably already got there in your portfolio. And they'll become more important as we transition on this journey. But debt as well, government debt supporting these type of initiatives. I mean, if I think about the railways example again, it was doing great until government regulation got ahead of it in the 1920s and stopped the rollout of public transport. And that's a lesson we need to learn through this cycle as well. But it's not so much an asset class, but I think, like ESG integration, it's a risk you need to be aware of in your portfolio. And the way to manage that risk is through some of these smaller investments at the moment that are driven by this catalytic change. It's not just developed markets, it's emerging markets. Credit where credit's due. China was one of the biggest investors in solar and renewable assets last year. And if you start thinking about sort of a value investment perspective, the expected returns on renewables in emerging markets are higher than developed markets. So there's an opportunity for value investors and growth investors to play the same thematic. One of the new areas that emerges from it is carbon. So this is the net side of net zero. As you can see, most of the change is actually driven by a reduction in carbon, the chart on the right-hand side there. And the net side's getting bigger, but we can't address this problem simply by delivering offsets. This has been, our exploration into this asset class has been somewhat disappointing to learn that after speaking about it for a decade plus, that it's really still quite a nascent investment. It's tempting to think about carbon as a commodity, to treat it like you would copper, iron ore, lithium, oil. But when you start digging under the hood, it's really anything but a commodity. The contracts are quite specific. There's project-specific risks. They're not unified. One unit of carbon is not equivalent to another unit of carbon. There's pricing of co-benefits. Actually simple things like custodying the assets. If you turn to some of the major custodians, they can't help you custody something like an ACCU today. It's great that we've got certainty, more certainty around the regulatory environment, but for financial participants in that market, it's really still developing. It pains me to say it, but I'm not sure that we're at the same stage of maturity as crypto in that market. So there are a few negatives in getting exposure to that area at the moment. But if you look at the positives, and if you look at the positives particularly from an asset allocation view, we went back and we looked for correlations. We can find periods of increased correlation between carbon and other assets, but actually it's really diversifying. Over time, those correlations are unstable. There's good reason to believe that the price of carbon, particularly in Australia at the moment, is underpriced. If you look at the average person in this room, we need about 15 tonnes of carbon each year to offset. If you go through at the current carbon price and you think you're going to live for around another 30, 40 years, it's not a large amount to offset your carbon footprint. Now that sounds really exciting. For $50,000, I can offset your lifetime's carbon. But of course, that's not possible. If we all go and do it, there is not anywhere near enough existing carbon assets at the moment to support that type of change. And just like any commodity, getting that last little incremental bit of supply gets really, really expensive really quickly. But the positive side is, at the moment, it's an emerging asset and appears to be underpriced. It's likely to be diversifying in your portfolio, and I think there's a place for it. Thank you.
Thanks, John. Yep, James, I think you're up.
Thank you. Good afternoon. I think a lot of what I'm going to talk about pretty much supports what John was just saying, but I'm going to talk a little bit more high level around portfolio construction, how we're thinking about net zero across the whole portfolio. So similar to John, I don't believe, and we don't believe, that net zero is an asset class into itself, but the transition to net zero is definitely a risk that we have to manage across the whole portfolio. And I'm looking at my colleague who's the head of sustainability for Australia. He's got his eyes on me, making sure I'm not saying anything a little bit too incorrect. But as we think about that, I think most of the conversations that I've had in Australia are around indeed thematics, around how do you get access to the transition, be it EV cars, be it solar, other technologies. In reality, I've never had a conversation about how do you think about climate risk in the portfolio. When we think about constructing portfolios, it's about risk, return, cost, and maybe some other metrics. We never think about how is the transition going to affect my portfolio and my returns over the long term. So back in 2021, Blackrock actually introduced a new framework for our capital market assumptions, our long-term assumptions on risk on asset prices, where we actually bake in our assumptions on how climate is going to affect those returns over the long term. So we're actually building it into our portfolio construction process. And similarly, when we're looking at building portfolios, we're looking at risk and return metrics continuously. We're looking at the macro environment. We're looking at monetary policy. These are all things that you'll be looking at when you're building portfolios. But now we're constantly looking at carbon emissions. We're looking at other metrics of the portfolio to see how they're tracking in terms of the carbon footprint and the transition to net zero. Back in that paper in 2021, we said that we believed that the transition to net zero was going to be a growth benefit for the global economy, which went against the notion that everyone thought was going to be a net cost to the economy. If you think about the typical or scenarios that can ensue from where we are today, we can do nothing, and we can kind of go off to infinity in terms of CO2 emissions over the next couple of decades. We can potentially transition in an orderly way to net zero at 2050, or be somewhere in between. If you look at the investment thus far that we've seen, so enacted policies, those are ones that have actually been put into implementation. By 2030, we'd expect around $2.2 trillion to be in renewable energy by 2030. If you look at pledges as well, that takes us to around 2.8 trillion in terms of investment by 2030. What we need to get to net zero by 2050 is around 4.4 trillion in terms of investments. So we're not there yet. We're actually behind the curve in terms of where we need to be if we want to actually reach net zero by 2050. But what we are seeing through regulatory change, particularly in the US and Europe, so I think it's the Power EU, the new power regulations in the EU, and also the Inflation Act in the US. There's a lot of expenditure going in and investment in renewable energy, which is going to push investment forward, and hopefully we're going to pick up the pace and hit the trajectory that we need to hit net zero by 2050. Now, what is important is that I think we recognize this isn't going to be a smooth straight line to 2050. It's going to be a bumpy road. There's going to be ups and there's going to be downs, and there's going to be volatility. So even before that, about 5 years ago, we started incorporating the notion of uncertainty into our CMAs, which instead of using point estimates, we're now using bands of uncertainty. So we can actually build in uncertainty in these paths into our CMAs and use that as a way to construct portfolios rather than just relying on one point estimate. So what does the process look like? We try and break down the CMAs into 3 different channels where we're incorporating climate-related risks into them. So the very top level is the macro channel, where we're thinking about how does climate-related activities or the transition affect global GDP. So we're looking at our normal fundamental way of thinking about our CMAs and then overlaying climate views, both positive and negative. The repricing channel then is more about the notion that investors are starting to think about investing differently. If we see more investment into the transition, more into renewable energy, more people will want to invest, and that will lead to repricing. And we still think there's still repricing to come. We don't think this has been fully baked into markets. So there is still upside from investing into the transition. When that gets priced in, there's less of an opportunity to create outperformance. Interestingly, one of the things that ensues from this is that we will see macro volatility because of the transition, and we also believe that there will be supply-side inflation due to the transition also, and that will impact asset class views. Lastly is the fundamentals channel, which is when we think about how the fundamentals of companies are going to be affected by the transition and by climate change. To do this, I mean, each company will be different depending on its circumstances, but we do it on a sectoral basis. And one of the conclusions that we had from this paper is actually more granularity in portfolio construction is needed to manage this risk more effectively. So we looked at 34 sectors overall globally to understand the differences. At the time in 2021, IT and technology looked pretty positive from a transition perspective. As you'd expect, energy looked most negative. What we actually saw last year, as we talked about earlier, was that energy performed very well. So I think what we've recognized and what we now look back at and realize is that there are still going to be supply shocks and mismatches between supply and demand on energy. So how you manage this risk and how you manage this transition is going to play out in your portfolio. If you decarbonize too quickly and then you see these supply shocks, then you could potentially lose out in terms of performance. Conversely, if the market decarbonizes quicker than you're decarbonizing in your portfolio, you can be left with assets which aren't going to perform very well. So this is the challenge. This is how you manage the risk across the whole portfolio. The other knock-on effects that we saw across asset classes, so we've been an advocate for inflation-linked bonds, global inflation-linked bonds for a while now. Part of the advocacy for that is the fact that we see inflation playing through the transition. There's obviously a number of other issues that are causing inflation globally at the moment, but that's one of them. And it's also led to a preference of developed market equities over asset classes such as high-yield bonds and emerging market debt, just owing to the companies that you get exposure to as well. So in that whole portfolio approach, what's important to note, like I said previously, this is going to affect every single asset class. So you can't just think about one asset class by itself, you need to think across the whole portfolio. So when you're thinking about that whole portfolio, you have to think about defining your targets and defining your strategy and defining how you want your decarbonisation path to look like. And potentially implementing newer CMAs that take this into consideration. When you think about product suite, yes, it's about using thematics. Yes, it's about core exposures across both index and active to create a portfolio that hits your return targets, but also has the ability to manage these risks in the portfolio too. Now, what's core on all of this is ensuring that you've got good data and good analysis. And data is actually very hard to come by in Australia, which I've found over the last few years. But it is critical to have that when you're actually assessing your portfolio. So before you know where you want to go, you have to know where you are. And to know where you are, you need to look at your portfolio and understand your current carbon exposures. And using technology, and there are more technologies becoming available that enable you to do that. Blackrock uses Aladdin. We've developed a lot of new modules of Aladdin to account for this specifically, Aladdin Climate. It also allows you to measure your portfolio on a regular basis to make sure you're actually hitting your targets and transitioning in the way you want to, so you can actually show progress. Now that middle bit there, which is where do I want to go, we see different clients implementing climate strategies in different ways. So some will simply replace their building blocks with building blocks that are more focused on climate, on the transition, more broadly, sometimes a little bit more across ESG more broadly. The second way that we see this happening is blending existing exposures with more climate or more sustainable focused exposures. So that enables you to manage climate risk, but also maybe other factors within the portfolio, be that exposures, risk, etc. And then lastly, for clients and investors who are completely focused on this transition and are completely bought in and they're very bullish on it and they want to build it into everything in their portfolio, we see them completely designing their asset allocation based on CMAs which incorporate climate and then also use products to implement it as well. So implementation can go two ways, either through asset allocation or through product selection, but we see in reality clients doing both. And just to finish, I think we've run a bit over on these talks, but we've seen the sustainability product platform grow across the industry quite substantially over the last 10 or so years. More and more products, especially in Europe and the US, are focused on transition strategies, so aligned to Paris-aligned benchmarks, for example. What we've seen in Australia is more and more thematic funds being launched, so solar energy, lithium, ETFs on EV cars, etc. So we're seeing a lot of investors play this through thematics in Australia particularly. But the one thing that I would say is that we advocate not just that, thinking about across the whole portfolio, thinking about your transition risk across all asset classes and using all the tools available to you when you manage that risk. Thank you.
Thanks, James. Like I said, I will throw to the floor shortly for questions, but John, I'll start with you, and I think you made good reference to the opportunity set by referencing to railroads as an example, and then you also mentioned Amazon as well. But of course, with railroads, there were many railroads failures back in the 1800s in what was a boom time, and then with Amazon, you know, Jeff Bezos was the CEO of two companies, Pets.com and Amazon. One no longer exists, one everyone knows. So when allocators in this room are making investment decisions around net zero, given all the disruption taking place, how does one navigate that, whether they're allocating on their own or entrusting someone like yourself?
Yeah, I think that's a really good point. I think it comes back to James's point around thematic investing. So, you know, one of the issues with thematics is they run hot and they run cold, and they tend to take a few times to get started. So one of the ones that sort of comes to my mind is around 3D printing. 3D printing kicked off in the 1970s We had a go at it again in sort of the early 10s of this decade. And I think if you've been holding it that entire period, you've almost got your money back now. AI, again, falls into that same type of category. You know, my lecturers at university studied AI. I studied AI. My kids seem really excited about studying AI. And I'm still, maybe now, we're just on the cusp of seeing those benefits. So, you know, when I was speaking before about, you know, we've got the two scenarios at both ends of the tail, a negative climate and a positive climate scenario. What thematic investments can give you is that convex exposure to the thematic, particularly when they're at the right level of valuation. So they're an important component in your portfolio, but when we construct our multi-asset portfolios, we're still focused on another 5 other scenarios which aren't positive climate change to make sure we're managing those risks for what might lie ahead.
And James, that kind of ties in with what you were saying, where I think you said you don't focus on point estimates when you're making decisions. You focus on a range of probabilities. Could you maybe expand on that by specifically stating how you actually structure that to make allocation decisions?
Yes, I think historically we would have used a traditional mean variance type optimization, but the problem with that is it tends to skew to either the least risky or the most returning portfolios. The CMAs that we've now built will have a quite wide range of uncertainty around a median estimate. And then we're using simulations to look at all the different possible combinations of those asset classes. So we can actually drill down on, okay, we're fairly positive, but actually what if we're on the bottom side of that? We can look at all these different scenarios. So it is more statistical. It's more based around the different outcomes that can ensue from that. And we can therefore kind of build in the variability of returns that we may expect. I think when we're building portfolios and we say Aussie equities are going to return 7% in 10 years, we're never right. But we need to look at the bounds around that when we're building portfolios. To your question, to that similar related question, when you think about investing in thematics and investing in these sorts of things, we've seen some very narrow thematics crop up, like lithium and other type of investments. They can go in and out of vogue quite quickly, as John was saying. So more broad thematics, more aligned with this kind of these trends that are going to be shaped over the next 30 years, are a way to diversify that rather than being really focused on one subsection of the theme.
And John, you brought up a really interesting point in terms of convexity and VC and unlisted markets helping you own the right tail in the net zero transition. But we're at a managed accounts conference, so I guess most people in this room would be running daily liquid portfolios. Can you still own that upside right tail in the public markets from what you've seen?
Yeah, I think, look, I think you can. It's obviously a little bit more difficult and you need to be a little bit more deliberate in the way you start looking for managers in your portfolios. I mean, one of the nice things about the Australian equities market is it's got a really big tail of exposures. You know, there's 2,000 stocks listed in this market and most of us only invest in 100 of it. You know, the team that I'm working with, because we're focused on how do we address these future problems, they're looking all the way through those 2,000 names, and there's plenty that are linked to this thematic. But obviously, they're a smaller market cap and play a different role in your portfolio, but in a listed daily liquid form, they can start to replace some of that VC and private equity exposure.
James, you seen anything in the public markets that help you own that upside for net zero?
If I could switch to private markets quickly, if that's all right. Just because we're seeing a huge amount of interest, obviously, from the institutional side in private markets. And you've got the ability to kind of see where you're deploying your capital in a very impactful way. So you can invest in the solar arrays, you can invest in the companies that are building that. What we have seen in other markets in the US and Europe is the democratization of those asset classes. So the ability to access that for a broader wealth audience. And I would hope that developments in the local market will allow us to do the same as well, because I think that plays a crucial role in portfolio construction when we think about net zero.
And James, you mentioned that you know, the thematic themes are very kind of popular in Australia in terms of a way to allocate, and of course, like a retail favourite would say be a lithium ETF. how does one, John, go about sizing that in a or allocating to that in a multi-asset portfolio, because it is quite niche and specific?
Yeah, look, I think again, it's understanding the risk reward of the investment. You know, what role does something like hydrogen, lithium play in your portfolio? They are to be catalytic. You know, you could start thinking about it the same way as you would think of, you know, a tail protection strategy for your portfolio, except in a positive sense. You know, but you know, I guess I'd encourage that they are one way to gain exposure to this portfolio. But I think, you know, broader than that is making sure the rest of your portfolio is understanding these risks as well. And there's, you know, larger exposures that you can think about. There, like I sort of mentioned, you know, infrastructure is a far more stable asset class, and it has a place in this transition, a very important place in this transition as well.
And James, you mentioned the iShares platform for the net zero from screening all the way up to impact. Do you see some clients implementing each part of the platform? Say, for example, as a core, they might, as a minimum, you know, negative screen their portfolio, but then, you know, to add some right tail upside, they might own a small slither of impact. Are you seeing people actually approach it like that?
Yes, I mean, I think if you look at the global platform, we've got 1,000 ETFs globally. So a lot of this portfolio construction is happening predominantly in Europe, just spurred along by the regulatory change. And you do see clients building portfolios that are wholly invested in Paris-aligned benchmarks, transitioning their portfolio to be less carbon intensive, but then playing some of these broad thematics in the portfolio as well. And that the same is not just for equity, across fixed income also, and trying to think across the whole portfolio. So we are seeing that transition globally with portfolios. I think we're not seeing that here yet. The product development is still happening by us and by other providers to provide the building blocks to do that. I think most of the interest that we've seen is through those retail type products that you've mentioned. But you know, we're talking about it here today. It's happening in the wider wealth community. So we're having the right conversations, and I'd expect it to happen across most wealth portfolios in the not too distant future.
And John, you're responsible for some significant multi-asset portfolios. When you approach your portfolios from a net zero perspective, are you integrating that in every investment decision you make? And you know, do you start from negative screening as a base effect and then move on from there?
Yeah, so there's you know, Australian Ethical has sort of two elements to its approach in portfolio constructions in multi-asset. So one is around that scenario process that I described, thinking about what the future paths of returns could be, whether we're successful in our net zero transition or whether we're not. But every investment we make, we screen for a positive ethical impact. So that can be social as well. But the broad risk management, return management comes from that overarching scenario process.
Are there any questions from the floor? We'll bring the microphones around.
Matt?
A quick question. You know, we've certainly seen some headlines on the greenwashing themes and everything else. And we all know, you know, the media loves to, you know, pick on sensationalism and the like. How much do you think those risks will derail the potential in the, you know, in the medium term for these sorts of assets?
It's a really good question. I guess, you know, in terms of the asset value themselves, some of the greenwashing concerns that I've seen to date have been born out of people not actually buying the assets that they say they do. I think that's a different problem and right to being addressed. Is it stopping the propensity of people to try and address the problem? So, you know, are we stopping because we're looking for perfection rather than focusing on progress? Look, I don't think so. You know, investment managers have always needed to be careful about communicating about what they're trying to achieve for clients. It's a much more complicated discussion now for advisors and ourselves, where, we're communicating in 3 dimensions rather than 2 dimensions. But I don't think it's going to stop the money flowing to the assets that we're required to do to achieve the outcome we're looking for.
Yeah, I broadly agree. I think, there's been confusion on labelling of products by investors. So we'd support anything that is more transparent and easy for clients to understand. And ensuring that products are true to label, as you mentioned. Will it derail it? No. There might just be a few periods when we have to kind of clarify what products are and how to use them. But inevitably, I think we're still going to transition in that direction towards 2050.
I got a question that probably follows on to some extent from that one. I mean, I know, James, you mentioned how there's been much more of a move in Europe to funds and investments on Paris-aligned and so on, and maybe not so much here. We're also seeing maybe the other extreme in the US, where we've seen states like Texas, Florida, and probably others almost outright banning doing ESG screening and so on because of concerns for the oil industry or whatever. Do you think that there is a risk the other way, that things might move to the extent we're seeing in the US, that it actually slows down progress towards net zero, or could hurt some of the investments we're talking about?
I think it's become very polarized in the US. So there's definitely 2 sides to the story. In Europe, I think everyone's in unison across the EU to move in the right direction and transition away from carbon-heavy fuels. In the US, it's still happening. I mean, if you look at the bill passed by the Biden administration recently, there's a huge amount that's going to be invested in renewable tech. I guess there's always going to be a debate in the US, though, which may slow things down. But ultimately, I think the amount of momentum behind this globally means I think we're going to reach the point where we need to be in the future. But as I mentioned earlier, it's going to be bumpy. It's not going to be straightforward. There's going to be debate, there's going to be arguments, but invariably we have to understand that doing nothing is going to cause more harm than doing something now.
Look, I think that's concur with everything you've just said. I mean, I think even from an Australian perspective, right? I mean, I operate the multi-asset funds in a super fund. There's a sole purpose test there. Every investment we make needs to stack up on a risk-reward basis. And when we look, with a long-term view, for the types of returns that are possible in a lot of these assets, they just stack up. So, it's nothing like the politicians to get away with a good solution. But I think, there shouldn't be anything to actually disrail this transition.
Can I put a counter argument to that, which is that we dig up coal here and send it to China, who are currently building whatever it is, 25 times they're currently building 25 times our installed base of electricity generation. So we're going to re-import energy in anything that's energy intensive. We are going to import by virtue of the Chinese not subscribing to a net zero. So we're going to get a bipolarization of the world where China has cheap energy, India probably has cheap energy, and Australia, Europe, and the US have expensive energy. Do you think that's a situation that will be allowed? That will continue, given the destruction that'll cause to any energy-intensive activity in, certainly in Australia?
Look, I think this is the reason why getting the right data is so important. Scope 1, Scope 2, Scope 3 emissions help you address some of these problems. I mean, when I look at it simply, if we just added up all the Scope 1 emissions, we'd get the same answer as Scope 3. But by understanding the data properly, we can see how they're being contributed back in. And I think with that type of data, we can start to address some of the cost advantages that some might be perceived to have. Now, while the headlines say that, in 2021, the largest investor in renewables was China. So I think they're well aware of what's required for this transition. And, credit where credit's due. They embarked on a significant infrastructure build to support their economy at the end of 2009. And a lot of that low-hanging fruit around transport, the type of transition we went through in the 1900s, is already gone. So what are they going to address this time? I hope that they start to address this problem by investing far more significantly in renewables.
I believe that China have committed to 2060 in terms of decarbonisation as well, so that they're on a slightly longer path than everybody else. But if they no longer need coal in 2060, then what are we going to export to them? So there's that consideration. But then, you know, to your point, I mean, if you can build renewable technology, that should bring down power electricity prices in the future and not be reliant on the ones that currently exist.
Sorry, I had a question that's probably similar to Toby's. You were talking about momentum, and the thing that I notice is that while we talk about momentum, and it's obviously identified, and it would seem to me that most countries around the world that have signed up to this lack a lot of momentum because they're not meeting their targets. And we regularly have reports of impediments, even Europe itself right now, given the current energy crisis with the war in Russia and everything else. You know, these are significant roadblocks to the sort of net zero narrative around 2050. Is that part of your calculus?
Yeah, so in our process, we have a probability around our success of reaching that goal. That probability at the moment is only 10%, which captures some of the roadblocks that we face. A successful...
So can I just say though, just on that point, that 10% point, which is very important that you've admitted that, that's not obvious to your average punter, advisor, investor. So that confidence level and the momentum that you talked about is opaque, you know? So the case you've presented is positive, and the way you're running your business is taking those things into account. But it's now at the end of the presentation that you say that your confidence level is only 10% in achieving it. So I really think there's got to be some more integrity about this conversation, more broadly, so that people do know that there are, you know, confidence levels as low as, say, 10%. And for instance, even in the climate report itself, there are significant variances in the level of confidence if you look at the three levels of it, which is not often brought out in the media. And I think there's a whole problem, and you're going to face increasing headwinds as people start to realise that it's not as simple as what it may be, you know, reported as a headline, as some sort of catastrophic headline. And I think one of the big bugbears of people in the environmental movement is that is becoming an impediment. And people are beginning to say, well, hang on a sec, you told me this 5 years ago, you told me this 8 years, you said this in 2007, and we're still here and we're going around in circles. What's the real story? Do you know?
Yeah, look, I absolutely understand. And look, that is, if it was 100% probability, it'd already be priced. And the opportunity for investors to benefit from this would be far less significant. And that's our process, is to monitor the progress we've made and update those probabilities. The setbacks following last year, we downgraded the probabilities of meeting those objectives. But, you know, I don't think anyone's under the illusion that this journey is difficult. I really hope they're not. Because if people think we've got this scunned, it's not going to attract enough capital to actually address the problem that lies ahead of us.
Yeah, I think I mentioned in one of my first slides when I was presenting earlier that, you know, the commitments and pledges only reaches 2.8 trillion when we need 4.4 by 2030. So we're well behind the curve in terms of what we need. But we need to keep on having the conversation. We need to keep on pushing it. If we say it's not going to happen, then it won't happen. So I think part of that is kind of, yeah, being open about the risks, but keep on talking about it to kind of push that narrative. Otherwise, we're just going to be where we are in 10 years' time, and then the risks will be far greater than they are now.
All right. Well, thank you, gents. That was a great session. We appreciate that. Please thank the panel.